I'm going to be debunking 5 tax myths to help you get more money and stay out of trouble with the IRS. I'm also going to show you why it's a good thing if you pay lots of taxes. Most people don't realize how much they're actually getting taxed. And the government is going to get their money one way or another. Americans are taxed at different times at many different levels of government. And you usually have to pay federal taxes, state taxes, and local taxes. Federal taxes usually consist of income tax, employment or FICA taxes, which pays for Social Security and Medicaid and is split up between you and your employer to have to pay for. Then there's also gift taxes for any gifts above a certain amount, and estate taxes, which taxes whatever you leave to your kids or other heirs when you die. State taxes mainly consist of income tax, sales tax, and other charges like state tuition, highway tolls, and hospital payments. These are charges technically not taxes, but they come out of your pocket nonetheless, so I'll include them. Local taxes are mainly property taxes, sales taxes, and other charges like sewage and parking fees. So basically, whenever there's an exchange of money, whether from an employer to an employee, or from a company to a shareholder, or from a store owner to a customer, the government is going to get their money. It's a complex system, and that's why it's so confusing for a lot of people. Now first, I just want to say I'm not a tax professional, and every situation is different, so if you need detail on your specific situation, go see a tax professional. But I have learned a few things over the years, and one thing that I have learned is that a lot of people just don't understand taxes at all. Myth number 1. There's a big misconception about how tax brackets work, and a lot of people are afraid to make a little bit more money because they think they're going to be jumped up into the next tax bracket and then bring home less money. This literally never happens, but almost everyone I know thinks that it does. While we do have a progressive federal income tax system, meaning you pay a higher percentage of your money in taxes the more money you earn, it's still based on what's called marginal rate. The marginal rate is what you pay only on the additional dollars that you bring in that tax bracket and not on your entire paycheck. So based on a married couple filing jointly for 2024 tax brackets, if you were making $94,000, which is in the 12% tax bracket, and you did a little bit of overtime to bring in $1,000 more, or a total of $95,000, you would be pushed into the 22% tax bracket. Now people think you would have to pay 22% of your income or $21,000 in taxes as opposed to 12% or $11,000 in taxes, even though you only got $1,000 more. So of course, people choose not to take those extra shifts and even forego promotions because they think they're going to bring home less money. And that would make sense if this were true, but it's not. But in reality, you only pay 10% on the first $23,000, so $2,300 in taxes, 12% on the next amount of income from $23,000 to $94,000, which is equal to about $8,500, and you'd only pay 22% on the amount over $94,300, which is only about $154. You add all that up and you would only pay a total of $11,000 or a little over 11% of your income towards taxes, not 22%. So you would still bring home $800 more with the raise, even while being in a higher tax bracket. There really is no circumstance where you'd actually bring home less money, especially when you consider that 32 out of 50 states require some kind of additional overtime pay. So those extra hours are not being worked in vain, and it's very important that you do whatever it takes to secure for your financial future. And if you do have to pay a little bit more taxes in the process, hey, it's a good thing. It means you're making more money. And part of making more money is contributing more in taxes. Myth number 2. People think that getting a tax refund is a good thing. It ain't. Now I get the emotion of it. You may have been afraid that you'd actually owe money to the IRS, or at least you wouldn't be expecting anything at all. So it's a very nice surprise if you get a refund and weren't expecting it. I get that. But it doesn't change the fact that a refund just means you paid too much in taxes and the government is giving you back your own money. The government isn't being nice to you and giving you free money. It's the money that you've already worked for and that already belongs to you. You basically just let the government borrow from you without getting any interest. You could have at least put that money in a high yield savings account making 5% on your money. The average refund is $3,200. And if you got that refund, that just means you were overpaying each month by about $267, which you could have been using to save or pay for bills. Now you didn't miss out on anything big by not getting that interest. It's only like $40 or $80. But just know that the government didn't give you a gift. The idea is to adjust your withholding so that you don't owe any money and you don't get any kind of refund. Myth number 3. A common myth is that the high interest rate on your home doesn't even matter because you can just write it all off anyways. So just buy as much house as you want and get a tax write-off. And if you do have a home, don't pay it off because you don't want to lose that tax write-off. Look, having a mortgage on your personal residence isn't a good thing. It's more of a necessary evil for most people. And you never want to keep a mortgage or get a bigger mortgage just so you can save on taxes. And there's a couple reasons. First, the mortgage interest is a deduction, not a credit. And most people don't know the difference, so let me explain it to you. The tax credit reduces your tax payments dollar for dollar, but a tax deduction reduces your taxable income. So you're really only saving your tax rate on that money. So for example, if your income is $100,000 and you just bought a home with a $360,000 mortgage in January, your mortgage interest this year would be almost $26,000. But you don't pay $26,000 less in taxes by taking the deduction. It just reduces your taxable income from $100,000 to $74,000. So to make it easy, let's say your effective tax rate is 10%. This means your mortgage interest deduction would take your tax payment down from $10,000 to $7,400. So it's really only saving you $2,600, not $26,000. And that's a big difference. And this may sound good, but remember, $26,000 in interest is going to the bank, which is not a good trade. And on top of that, your mortgage interest is front-loaded in your amortization schedule, so those savings will drop every single year. The second issue with this mindset is that most people can't even take advantage of the mortgage interest deduction because they don't itemize on their taxes. They take the standard deduction, and you can only deduct mortgage interest when you itemize. The standard deduction for 2024 is $29,200. So unless you spend more than that on mortgage interest and other things like charitable giving and medical expenses, you wouldn't itemize. And therefore, you can't take advantage of the mortgage interest deduction. Now, high interest rates do make it more likely that it will make sense for you to itemize, but the fact is most people end up taking the standard deduction. Depending on what state you're in, between 3.5% to 20% of people itemize, and those are usually people that make a good amount of money. And this is the same issue that applies to other things like charitable giving. I've heard a lot of people discount the good other people do by paying tithes or giving to charity because they say, hey, they're only doing it because they get the tax write-off. And yes, it's possible for a minority of people, but it's not the case for the vast majority. I've never actually been able to write off my tithes and charitable giving because I've always taken the standard deduction. And people who think this way most of the time aren't that generous anyways. And again, charitable giving is not a tax credit, it's a tax deduction. So you're still only getting back a fraction of what you paid. And if you are one of those few people that give just so you can get the tax write-off, you should really check your motives and your money because you ain't getting that money back. Myth number 4 is that you won't feel terrible if you forget to hit the subscribe button before the end of the video. You will, and you're never gonna forgive yourself for it. So go ahead and do that before you forget. Just kidding. But no, really, hit the subscribe button. It's a myth that you don't have to pay taxes if you get paid in cash. This is something called working under the table. And I don't know if a lot of people are just purposely playing dumb or they really have no idea that you have to pay taxes on that money. But I think a lot of people think it's okay because so many people do it. Whether it's barbers or babysitters, handymen, musicians, painters, landscapers, just to name a few, are all people who commonly get paid on the table and don't report income. Now, I understand the appeal of this because you don't have to pay taxes, and so you're basically immediately getting a 10 to 20% raise because the IRS isn't taking their cut. You may even be able to qualify or stay on public assistance, even though you may be bringing in more money than you're supposed to. But there are some potential repercussions to this. The first issue is that if the employer that's paying you gets audited, they're probably gonna find out about you as well. The second issue is that you're not able to show that money as proof of income when you try to lease an apartment or apply for a home mortgage or other loans. And that might hurt you in the long run. The third issue is if you get hurt on the job, you won't be able to collect workman's comp because your employer hasn't been making payments on your behalf. And if they lay you off, you won't be able to collect unemployment because there was never any record of you working there in the first place. And the state has to have some kind of record of your employer contributing to the insurance requirements if you want to be able to get unemployment. The fourth issue is if you get caught, you may have to pay penalties on top of the taxes, and you may even be sent to prison. And that's just not worth the risk. And if you pay more in taxes because you report your income, well, that's a good thing. That's what you're supposed to do, and it will keep you out of trouble with the IRS. And it's really a moral thing. I mean, just do what's right. Render to Caesar what's Caesar's and to God what's God's. It's a myth that you won't get audited if you don't have a high income. Now, it is true that the IRS audits a higher percentage of millionaires because that's where the money is after all. But this doesn't mean you are exempt if you make little money. And you're actually more likely to get audited if you make $15,000 as opposed to making $400,000 a year. And this is because people who claim the earned income tax credit are much more likely to get audited than most high earners. The Earned Income Tax Credit is there to help low to moderate income workers and families get a tax break. And you can technically actually get more money back than you owe in taxes, so it can essentially act as a welfare program. A third of the EITC payments are made in error, so it has a high fraud rate. The IRS audits more of them to make sure no one is taking advantage of the system. But in any case, you aren't saved just because you don't make a lot of money. So to sum everything up, don't aim to get a tax refund or owe taxes. Don't keep debt just to get a tax deduction. Pay your taxes regardless of how you're paid, and keep good records and receipts because you can always be audited by the IRS. And most importantly, go make more money and don't be afraid to pay more taxes. And when you do go make more money, make sure you get free money from your employer. You can check out this video if you want to see how. Thank you.